Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to give us the recap of housing in 2025. So excited for that. Before we dive in, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, and we are closing the books in 2025.
We're getting close. I mean, we have a lot of podcasts between here and the end of the year, but as far as like what we're going to talk about today, kind of looking back, doing a like what happened this year. So let's start. What is the most important thing from your perspective?
So I thought the most positive story for 2025 was the inventory growth. We always talk about our slope of the curve economics and how we look at inventory. And as long as mortgage demand is like suppressed, inventory can grow and it gets to a certain level. This year, the inventory growth was really good. Like at the start of the year, I was like, big smiles. I was like, this is really positive. But things started to slow down. And then just like all the other times, when rates start to get below 6.64%, demand picks up a little bit. And then we could see it in our tracker now. I mean, our total pending home sales is at a 4-year high now for the calendar week. And we had harder comps last year too. We have a clear deviation from 2022 and 2023. But versus 2024, still some growth. So the backdrop is good because to me, more inventory, more choices, less seller market, more buyers come in, right? No more multiple bids, anything. We don't have to worry about any of that. That you could have mortgage rates to just get down to near 6% and then have something of a functioning market. And that was the whole concept of team higher rates, right? That had to work for that to happen, or else you don't get any benefits, no inventory growth, prices still stay too high in the sense that the growth rate is above 4.6%. Now, not the case. So that to me is the best and number one positive story for the housing market. It took a while to get there, but we're finally at a marketplace where buyers and sellers and choices and price, everything is now more in a balanced setting.
Yeah, I feel like inventory was the story. 2021, 2022. It felt like, when you have people lined up, 25 people to buy a house, it felt like there was no inventory to buy.
Well, here's the thing. We had 2 million more existing home sales with inventory at all-time lows. So a lot of people quietly asking, hey, wait a second, how do we have a lot more home sales with no inventory? Well, most sellers are home buyers, right? We do transactions a lot more faster now. So, in the past decade, when people used to tell me, sales can't grow, there's no homes, there's plenty of homes to buy. The problem with the inventory story was more about prices getting out of control. It was very unhealthy, so many things were waived when people were buying. It was horrible, right? It was savagely unhealthy. But now you have choices. And because you have choices, you don't really have to worry about mortgage rates coming down to 6% and home prices. No. So that was the problem with that. We had 2 million more existing home sales with lowest inventory ever. But with more choices, price growth slows down. Days on markets grow. Buyers now are part of the mix. That needed to happen. So it was more about the price growth story and the choices than, there are no homes to buy. And just it's a very confusing topic, but people always ask me, they're like, how did we have so many home sales when there was no? Well, it's the buyer seller transaction models have changed from what we used to be, 10, 15, 20, 30, 40 years ago.
So interesting. Okay. I know what you would say is the hero of the housing market for 2025.
Yes.
Give mortgage spreads their due right now.
The weekend tracker showed spreads at 2.06%. That's 26 basis points away now. I think that to me is I think so many people were shocked, because they hear mortgage spreads and they were always told that mortgage spreads could never go down unless the Federal Reserve buys mortgage-backed securities. And they have so much to the upside. I mean, stories and countless times over the last 3 years, people said spreads are going to get to 4, 5, 6, like they were in the early 1980s with inflation. I was like, that's kind of not how it works. But in any case, now that we're here, the 10-year yield really hasn't broken under 4% and had any kind of duration there for a very long period of time. But because the spreads are better, mortgage rates got near 6%. We would not have that duration of rates under 6.64 down towards 6 if the spreads didn't get better. And in fact, it's actually currently right now better than even my peak improvement forecast. So that's why the spreads are, and how we talk about it so much and we bring it up on the Nerd Tour and at our events. But now I think people could understand, it's so much better for the housing market when we're near 6 and not above 7. And we've had 2 economic cycles where spreads actually get lower going into a recession. A lot of people think it's when you're in a recession, spreads get bad, but when you're working from an elevated level, working lower, the spreads look kind of normal, going back to all these economic cycles since 1970.
Okay, let's talk about home prices and where we're ending up versus your forecast, your 2025 forecast.
Yes, 2025 was the second year of real home prices being negative. That means the growth rate of prices are basically below the rate of inflation, right? So that's a very kind of, that's a negative a trend data line. But last year, I had 2.33%, but I lost it when mortgage rates get down towards 6. I could see it in our data that pricing firmed up in the second half. This year, I would say the surprising thing for me is that I assumed that our prices would be negative year over year with our data going, until October, September, November, because last year was so strong. That didn't happen, but we're still kind of in that 1 to 2% range. So that worked out. And I always tell people, I never revise my forecast because we have a live tracking model every weekend. So we know exactly where it's going. So I'm most likely, most of the time, going to be not correctly 100%, but this year we might get close enough. And then again, that's just the slope of the curve, right? Active inventory is up, price cut percentage is up, rates stayed elevated enough. We haven't had the sub 6% mortgage market here. So it looks about right to me. You rarely get one of those years, and pricing firming up in the last few months in some of the reports that we've seen. It's just a function of rates getting a little bit lower and demand picking up just a little bit. But you can see the slope of the curve on inventory, where at one point we were 33% year over year growth. Now it's down to 13.69%. We had a bigger drop than normal in the last week, but still roughly double digit year over year growth in inventory going into 2026. Still a very positive story in my mind.
Okay, related to inventory, obviously new listings.
New listings, it's funny. This is such the dichotomy of all this economic talk in on the internet and everything. When you don't have working models, you don't really know what the new listings data is. So we were talking about, there's a lot of people that were talking about it's worse than housing 2008. It's not even housing, it's worse than housing 2008. And I'll say that if it's worse than housing 2008, the new listings data would be worse than housing 2008. And even now, even this last week, I think the new listings data was 42,499. And then I'm going to compare this back to 2009, 10, and 11. It was like 380,000, 340,000. I mean, this is the seasonal decline period. And like 2010 and 11 were over 300,000 new listings. So just
weekly. On a weekly basis.
And so think about it for a second. Now you could take like 7 weeks of what happened with the new listings data, and it wouldn't even match 1 week back then. Because again, forced credit sellers, stressed credit sellers, sellers that weren't going to be buyers, people that did not want to even be in that position, but they were. And this is why the credit cycles, we always talk about that this was the 100-year test, right? For those that believe in credit markets and all this stuff, we had 2006, 7, and 8 versus 2023, 2024, and 25. You could not have 2 different periods of times in the history of America that were so different. And that was the 2008 model. And we have people talking about worse than 2008. And it was just like, but when you show these people, it really shocks people. I've never seen it, what was happening back then to what was happening now. So the new listings data growth really started to slow down after May. Even I think this last week was negative year over year, but still nothing like 2023. We got up to 80,000. I'm always looking for a normal 80 to 100,000 during the seasonal peak months. We got up to 83,000 and then it stopped growing. So again, such a different marketplace when sellers get to decide when they want to sell and buy another home. So it is positive that we were able to get to the lower end of a normal level, but I wasn't too happy with the fact that we didn't get any growth during the seasonal period. And then again, everyone has to have their own models and things that they track. That was one of the reasons why in mid-June I said, boy, the housing market's shifting, right? So I think it's going to be 3 to 6 months before people figure it out. So it's just, again, everybody has to have their own live working model, but here you can visually see what has happened. So it's not shocking to us that there's a possible chance that the year-over-year inventory percentage might even go to single digits with a few weeks left.
I think that new listing number is always so interesting. It's one of the things you track every single week in the housing market tracker, and you always compare it to 2008 levels or that time period, because it's like, listen, if you're calling for the housing market to crash, new listings would have to be one of the first indicators.
It would go vertical. That's what I always say, because when it goes when you're working from the lowest levels ever, it's like the irony is that the last 3 years were the lowest levels in history. You think about it, again, 100 years of data now, and we put our models, our faces, everything out there for everyone to read, and it worked, right? That's mostly because of the 2005 bankruptcy reform laws and the 2010 qualified mortgage laws. But when you see stress, inventory goes vertical, right? A lot of people don't even know what new listings data is. They're like, oh, what's happening? But it can explain all the aggregate data of inventory going back to 1980 to 2025 to where we are right now. And again, 2005 active inventory NAR was 2.5 million. 2006 to 8, it went to 4 million. It had a vertical move higher. Then all of a sudden, all these foreclosures and bankruptcy, the tombstone chart that, you're going to put on my grave. We're going to say, here it is. What happened? 2005, 6, 7, 8, all these foreclosures, everything. And then new listings data, man, those homes didn't have sellers even in them. They were being foreclosed on. So it's such a unique cycle because you have over 100 years of data. These were two of the biggest different cycles in history. And that's normally the case. You don't usually typically have a bubble in the same sector back to back because whatever was driving that period is typically never happens again.
Okay, so you've outlined some of the places where your forecast very close to what's happening or what we're going to see by the end of the year. What surprised you this year?
Well, two things that surprised me. I'm really surprised that the median sales price didn't have a negative data year over year, October, November, and September as well. I just naturally assumed that would be the case because the comps were going to be. I was hoping we would get at least a few weeks over 80,000. That's another thing that surprised me because, rates, the housing data was acting a little bit better, even with elevated rates, but, people just kind of gave up on that. Sellers are stingy. Sarah, you always say this, so the new listings data not getting back to normal and not having negative year over year data in our data lines in September, October, November were the two most surprising things to me that I'll take back from 2025.
I think what continues to surprise me is just the level of volatility in like the news cycle, in some, in policies, if you think about, Godzilla tariffs, as you've called them. And yet here we are, and it's been a pretty good, not stable year considering all the other things that are going on.
When we look back in 2025 and we say, what are 3 things that the White House really needed to make this work? Number 1, lower oil prices. Check. Number 2, he needs a lower dollar while he wants to export stuff. Check. Number 3, he needs lower rates. They threw everything you could possibly go. No property taxes, 50-year mortgage, portable mortgages, capital gains, they threw all this stuff at this for housing, but the mortgage rates started to head a little bit lower. Demand picked up a little bit toward the end of the year. But when we think about what happened with the labor market, it's kind of what we thought in 2018 and 19. The economy kind of slowed down. Businesses weren't sure what to do. Right. And that's the problem when government comes in and starts, picking winners and losers or dictating stuff. And, people just can't make choices. That's one aspect. Of course, there's the rate sensitive aspect where the builders, right? The builders aren't going to be building homes in any big fashion with their completed units. But even with the builders, their builder confidence data came out today. It picked up a little bit. So this is now the 3rd time when rates fall that the builders' confidence does pick up. So it's a crazy year, but we're almost there. The economy was kind of in stack, but the labor market really deteriorated. And we don't have jobless claims or anything breaking, but it's one of these things to where if there's some clarity with the tariffs and businesses have a little backdrop with, expensing on manufacturing equipment and some tax rebate, whatever it is for 2026, I'm going to come with the budget. You have a better backdrop for maybe businesses deciding to do some hiring again.
We're having the Housing Economic Summit. February 10th is going to be amazing. You're our keynote speaker. We have a lot of great speakers, getting all these economists in one place on the same day. And they're starting to write their forecasts. We're publishing those. 2026 looks like a more positive year. So you're a positive guy. We've talked about what you saw in 2025. What did you not like about 2025?
You know what? Out of all the years in COVID, I love 2025 the most. I mean, it's weird to say that, but out of everything, the 10-year yield channel still stuck. Spreads got better. Inventory's up. Price growth slowed down. The labor data got weaker that, you never want to see. But the economy is still intact. So you're taking this huge, huge shock into the system called Godzilla tariffs, right? And we're still kind of still there, so I love 25. I mean, I'm literally even more than 2020. And we wrote the COVID-19 recovery model on April 7th, 2020. We were like games on and we had a lot of fun with that. But this year, I think about balance and for the housing market, and it got it. And with all the drama with the economy and everything else, we still kind of intact. So we kind of control our own fate on this. So I think, I don't really hate anything much on 20. Now, if prices grew above 4.6%, and inventory didn't get the growth it did, I would be less happy about this year. But kind of everything worked, to the degree. And just for me, for somebody that just wanted to see balance back in 2021 and 2022, how can you not be happy with this? That's the thing. The downside really is what we talked about 1 year ago, that the builders are going to have a supply and demand equilibrium problem, and housing permits have been pretty low for all year. We're finally going to get some housing starts reports, but lower rates will help that out, and then hopefully we could get permits going again. So kind of everything stayed intact. Everything looked right what it did. Considering we had Godzilla tariffs, a huge shock. Nobody thought we'd have Godzilla tariffs. We thought we'd go back and forth, smaller things. But we went just straight, into destroying cities with Godzilla's fire breath. But now it's all right.
It's all right. Okay, so I have been hounding you. I keep going, when are you going to write your 2026 forecast? This is our wrap up of 2025, and you have pushed that out. It will be at the very end of the year, and we are doing an end of the year podcast about it.
Yeah, I always wait to the end of the year. I mean, I still to this day cannot understand how some people do their forecasts like in October, November. Like, what? So much could happen, especially we could get the tariffs removed, any day now. So to me, it says I work everything off the 10-year yield channel and spreads and everything and how housing demand works, and we slope of the curves that I always wait till the end of the year so I could forecast everything. And remember, we do many variable assets going into the year, right? So we track them, right? This isn't one of these, hi, how you doing? I'll see you next quarter. 24/7 live. We have 4 podcasts now. We have a weekend tracker for everybody. Anybody who follows me on Instagram now, by the way, for all the Stranger Fans things, I think that's up to 12 million now,
so crazy.
Yeah, we bring it so we can teach this, right? I'm a teacher. My job is to teach economics, and this is the way to do it. And I love the forecast, right? When you're brave enough to put your name and face on something, and then you have a live tracking model that you show to everyone 24/7. You never like go, boy, homie, you are ready to play ball, man. You are ready to play ball 24/7. That's when I know who the real ball players are at.
Well, and I will say, on the tracker, you always put, on my 2025 forecast, this is what I said, and then you you tell where it is, where conditions are right then. So it's very obvious to people.
One of my favorite movies, Gangs of New York. Right,
and you and Gangs of New York, man. That movie, that's too. Yeah, but you still, like it too much.
But there's a saying in that: blood stays on the blade. We never look away. right? We never look away. Blood stays on the blade. We cut our forecast. We go in there. We fight every single day. We bring the models and everything, but we never look away. We never want to be that person that doesn't forecast, that doesn't show their face, that doesn't have a live working models. We never want to be that. Blood stays on the blade. We never look away.
Well, we are the beneficiaries of that. So thank you so much, Logan. Thanks for being on today.
Pleasure.